Good afternoon, everybody. CRNA Locum Jobs family and audience out there. We're going to get on Levi Carter today. He is an EA, owns his own accounting firm out of Oklahoma. He actually helps us with our taxes with the COJ business, as well as if I practice as a CRNA and a lot of other CRNAs out there too. I think he has a couple hundred CRNAs that he works with, but we're going to go over today with him and his team how it looks to be a part of real estate or even stocks, and how you can use any kind of expenses or losses when it comes to tax time. Thanks for joining us. I know it's been a little while since we've
Yeah,
had you on a live, but always appreciate you being on here. Levi and I have known each other for quite a few years, and we've worked together for several years as well. So he's a great wealth of knowledge when it comes to taxes and investments. He owns his own accounting firm out of Oklahoma and has several CPAs as well as quite a bit of additional staff. He helps a ton of CRNAs out as well. So we'll throw in the link for his accounting firm. It's also on our link tree in the bio of CLJ's bio on Instagram. So check him out there. But what are we wanting to discuss today, Levi? I know it's going to be real estate, maybe some
yeah,
stocks. Just talk about 1099 work, how we can kind of combine all that at the end of the year, how maybe some losses will
I love
help
it.
us. I always say it's not about how much money you make, it's about how much money you keep. So I'll let you have the
Yes.
floor for a minute and we'll
Yeah.
go back and forth and get some questions going.
Yeah, I'd love it. I really wanted to just have the made up argument of real estate versus stocks because there's pros and cons of each, and I there's a ton of people that are real estate only. It's interesting. I don't see as much the other way. I don't see as much market only people. Market only people tend to have some real estate in their portfolio, probably because you just generally have to buy real estate in your life, and so there's a comfort level. But there is a lot of people on the other side, as I'm sure you see on all the CRNA forums. There is lots of all in real estate people, and so both have advantages from a wealth building perspective. So and both have cons, pros and cons. So I'm excited to talk about it. But first of all, just wanted to thank you, Michael, and CRNA Local Jobs, just for being such a great resource to the CRNA community. I actually just had a call with someone you've been working on for a while, just last night at the very end of my day, that you told to reach out to me. And so it's whenever I get on those calls, and I'm sure some of the people that are jumping onto the live have experienced this, when they talk about CRNA locums, and this is different than all the other recruiters in the space, they're always talking about how much education they got, like how much of a resource on, hey, I'm making this jump from W-2 to 1099, and Michael or Jason or Shelby told me about this partner or told me to look into this product and health insurance versus this one. And so I think the education resource that you guys are is just such an asset to the
Yeah,
community.
I appreciate that. Yeah, it means a lot to us to not only just provide opportunities for our colleagues, but also resources, whether that's
Yep.
educational or for them being 1099. Because when you go from W-2 to 1099, it is kind of a lost world. What do I do with
Yep.
retirement? What do I do with investments? What do I do with my health insurance, malpractice? So we kind of want to be that sounding board to help our colleagues go into the locum world and make it a smooth transition.
Yeah.
Kind of, if you want to go ahead and get
Yeah.
started,
Yeah.
I do want to maybe throw this in there at
Yeah.
first. I know when it comes to real estate versus the stock market, if you're going to do like an external account or a non-retirement account to actually buy stocks, more or less, you have to have the capital or cash to do it. Now, when it comes to real estate, you may only need to throw down 5, 10, 15, 20%. And
Yeah.
now you can own 100% of that real estate. So I think that's a big variable when it comes to maybe tracking expenses or your cost segregation on the real estate side,
Yeah.
because you're actually getting a lot bigger piece of the pie versus when you have an asset such as a stock.
Yeah.
So if you maybe we just start in there and
So it sounds like you're talking about the impact of leverage in a real estate transaction that doesn't necessarily exist in stocks. And that's true. When we're talking about return, in theory, if we're just talking about return on investment, this could be a really short life. Generally speaking, I do pro formas and go over my clients' pro formas on real estate deals all day, every day, at least during the fall when we're doing tax planning. And generally speaking, on a real normal deal, we can get in a 5 year period. By the way, I always call real estate a 5 year bucket. I don't call it it's not a 59.5 year old bucket, which is an advantage if you're talking about saving money with a 401k versus real estate. And I also don't, it's not a short term bucket either. You've got to give it some time to let the system work. So I always view real estate as a minimum of a 5 year bucket. And in a 5 year return scenario, generally we can get most real estate deals, even in today's interest rates, to be better than an annualized return of 20%. Now, apples, if it were apples to apples, it'd be a short conversation, because if you compare that to the S&P 500, which has done outstanding in the last 7 years, in fairness, but in general, in a 30-year average, 100-year average, it's going to do 11 to 12%, maybe 10%, depending on which 20 years you look at. So 10 to 12 versus 20 to 22, it's a clear winner. But you actually mentioned why it's the clear winner. It's because there's leverage in the transaction. And so, what's really interesting is something that we do in the stock world that real estate investors never do is you're taught in the financial world, if you have some investment that could go to the moon, some moonshot AI startup company that in theory, when you do this analysis, because their growth rate, that stock's going to do 30% year over year over the first 5 years instead of 10%. Well, there's actually a mathematical equation that you're supposed to put in that versus when you're comparing that stock to Ford Motor Company, who's a little more stable. And there's actually a mathematical equation that we put. I won't bore anyone with details, but it's called a risk beta, meaning to make the return on investment equal of Ford Motor Company versus AI startup that's 2 years old, we actually equalize, they call it a risk adjusted return. Well, real estate investors don't do that, but they have risk in almost every transaction if they use debt. And so there's so many more factors that go into it than just total return. But to your point, your original point, because there's that debt and that risk in the transaction, you can lever up the return on your actual dollars. And so we put a really, for a tax investor, a syndication together every year. Ours is actually up to 30%. Like our 5 year return annualized over 5 years is 30% a year. So you can really lever that up, but there's risk in the transaction, and you've got to kind of constantly look at all angles and kind of adjust what are the true pros and cons. And so the other thing that I'd go into, Michael, is not just on risk, but just time. There's just a different time investment. And so I think you've got to really factor what is truly passive and what's truly not passive. But we can go into that later. But that's
Yeah,
my long
no,
answer
that's
to your
a
question.
great explanation. And I love that you're talking about the returns and how great they are. And I want to dive into in just a moment how it looks when we talk about what is called cost segregation. So even with commercial properties, I believe is it 39 years that those cost segregate over. But we actually have the bonus depreciation this year, and you can narrow that down anywhere from what, 5, 7, 9 years. So you take your property, maybe you have that, you've purchased it with other partners, multi-million dollar property, you can actually consolidate that into a 7, 9 year cost segregation. And that's what I kind of want you to hit on, because we have locums out there making 4, 5, 6, $700,000 a year, and they're looking for opportunities not just to purchase assets, but
Yep.
to also save money on taxes. So could you hit on that and maybe briefly discuss if they have a spouse that may be more of stay at home
Yep.
or working PRN, how they could qualify as a real estate professional, and then any of that cost segregation or expenses put onto that property now ties into your personal income. And now we can deduct that from that personal income and really lower that gross income down so we're paying less taxes as a locum CRNA.
Yeah, you set it up, set it really well, and set that up really well. And first, what I would say is I'd put that in the context of this conversation we're having about how much of my portfolio do I want in one direction or the other, real estate or stocks. And when we're talking about pros and cons columns, let's say all things were created equal, and you were going to get 14% in the S&P 500, you were going to get 14% in real estate. Well, one of the pros and cons on the one of the pros on the real estate side is going to be the tax advantages. Now, there's ways to get tax advantages out of stocks, but there's a lot more ways to get tax advantage with a lot less rules, tax advantages out of real estate. And just anecdotally, I'll say this. I always tell people, like I'll tell a new client that comes on board with us, I'll say, you can be aggressive as you want from a tax planning standpoint. I have a lot of CRNAs that are happy to take a $70,000 tax bill, have a planning session with us, and take it down to 45 grand. That's 25 grand that they couldn't have saved as a W-2 employee. I have a lot more, we have a lot of CRNAs that like to go to zero every year. And I will say that becomes addictive. The first year you don't pay any taxes on several $100,000 of income, it's really hard to pay taxes ever again, actually. Anecdotally, what I'll say to my point is all of my clients that go to zero every year are real estate guys or gals. I don't have any stock only people that can go to zero. There, that the leverage and once we get to the tax benefit, your actual question, the leverage combined with the tools that we have like cost segregation studies, there's just nothing else that can take someone that's got a net income of 400,000 down to $0 in taxation. So to your point, there's a number of things, not just cost segregation studies, but that's the famous one and that's the easiest one that we can squeeze, that allow us to squeeze a lot of depreciation out of a property. So what happens is an engineer goes through it and says, hey, this furniture is 7-year property. This light fixture I'm looking up at is 5-year property. The landscaping outside of this commercial building I'm in today is 15-year property. And the magic is anything under a 20-year class life in the IRS depreciation tables, so we can take bonus depreciation on. By the way, on commercial, if anybody's interested in investing commercial, there's something called QUIP. It's a special class life of its own called qualified improvement property. And if you invest in strip malls and triple net leases, QUIP essentially allows you to invest the entire build out without a cost segregation study. You don't even have to segment it and pay some engineer $4,000 to do it. It's just the whole interior build out can be expensed because it's 20-year property in bonus depreciation in year one. So there's all kinds of there's a new special one for manufacturing facilities. I foresee a lot of partnership syndications in that next year because of that new law where basically no cost segregation study, they get to expense 100% of the whole structure. So lots of fun stuff you can do. You bring up a more important question, which is how do I use that loss? How is it not a passive loss to me? And the answer is there could be many answers for you. The
Hey
hardest,
Levi, before you answer that, I want the audience to
yeah,
hear you have CRNAs that are locums, like just as we do. We have locums making 4, 5, 600,000, $700,000 a year. You have locums that go to zero each year when it comes to taxes because they are in real estate. That means they're paying $0 in taxes, but they also own real estate and asset. I just want you to
no,
hit
yeah,
that real
let
quick
it
and say
sink in.
yes.
Let it sink in. Yeah, no, it's a big thing if you're nowhere near there. I'm sure there's people on the call that are on this call because they love real estate and they wanted to hear the banter. But yeah, I'm sure there's many people that if you let that sink in. I remember my first year going to zero. It was a magical time in my life. But yeah, it's interesting, and there's all kinds of things, effective tax planning things you can do out of real estate. And again, if you want to take $100,000 bill down to 60,000 and that's never been availed to you as a W-2, that's wonderful. That's a great win. Um, I'm just saying all of the people that are able to go to zero. I'm sitting in the office of a client today that goes to zero every year and who makes more money than anyone on this call. And it's a wild thing to absorb, especially the first time you do it. And so but really that's how tax incentives are supposed to work. There was a famous leak a few years ago of Donald Trump's New York State tax return. and everybody wanted to see what tax fraud he was committing. And I knew exactly what tax fraud he was committing, how he doesn't pay any taxes. It's called depreciation. It's the same tax fraud that's available to you and I. And so it's a magical thing, but that's how tax incentives are supposed to work. What the government is doing is they're saying, hey, CRNA Joe, we want you to invest in real estate because it creates housing, it creates purchases for manufacturers, and it creates jobs for construction workers. It solves most of our societal economic problems. So we are going to incentivize that behavior. And so it makes sense. It's how the system was designed to work.
It does. Thank you for hitting on that real quick. Just that these
Yeah, no,
CRNAs
it's big.
making hundreds and hundreds of thousands of dollars as a 1099 locum. They have real estate and then they are not paying taxes at the end of the year, which just seems crazy. But to answer part B of the question,
Yeah.
how is that done or how does that look? And we're going to hit on that. Then I do want to jump in the chat because there's a couple questions we can go over as well after that.
Yeah, that's great. Yeah, I don't want to assume that people know the problem we're alluding to. So the 30-second problem Michael and I are alluding to is this creates a loss, but it's a different type of income than your CRNA income. It's generally real estate. Lots of types of real estate are considered passive income and passive losses. And so it goes into a different bucket that doesn't net with your ordinary income. So we solve this in numerous ways. A lot of these solutions will not work for you, but maybe one of them will. One of the ways that we solve for this is what Michael alluded to called real estate professional status. It's a pretty high bar to get approved for real estate professional status, but it doesn't. We do it all the time. Sometimes that's with a part-time CRNA, where we can actually get them to meet the requirements, the hours requirements. What's a lot easier is if you have a non-working spouse and you're going to aggressively go after building your real estate portfolio. And I say aggressively pursuing building the portfolio because if we're audited 3 years later and you ended up buying one property in that 3 year period, the year that we took real estate professional status, it would be pretty hard for me to stand on that position that we took. But, by the time anything's examined, you're buying 2, 3 a year. Some of them are, rentals that you actively manage. We can make that case. So real estate professional for a non-working spouse is something we do all the time. How can we document enough hours? It would be hard for a full-time working CRNA to do that. But real estate professional status, if you have that, it turns your all real estate related losses into active losses. So everything nets together. The other, and I would say this is more frequent, the other thing that we'll do is we will have a spouse become a passive partner in the CRNA's operating company. So what that's going to do is, let's say they were 49%, that's going to turn half of your CRNA income into passive income on that jointly filed return. And then you're going to have this suspended passive loss from whatever real estate activity you did. Sometimes that's easier to effectuate if you've got a spouse who's not involved in the business than real estate professional status. The other advantage that you pick up with that is, not air. We're going to go into the last way to do it, or the last popular way to do it, is the Airbnb loophole. But a lot of people don't want to manage those types of rentals. Like, they want a long-term tenant, 12-month lease. They don't want to clean up after a weekend party, and so that's not that's a great loophole that's talked about on the forums, but that asset class is not for everybody. The closest thing I have to it in my portfolio is I've got like a furnished finder medium-term rental, and even that's a very different thing than a weekend Airbnb type rental. So that asset class isn't for everyone, and so this gives you the opportunity to have long-term rentals that are truly passive income, and still solve for your tax loss problem, because instead of turning that loss into an ordinary loss, we turned your CRNA ordinary income into passive income, and where you have this passive loss from a long-term rental. And then, of course, the last one I've already mentioned, which is the Airbnb loophole. That is considered an active business, because services, it's still a real estate investment. but services are offered with the real estate. By the way, that's not the only asset class that could have that treatment. For example, a laundromat, if you bought the real estate, but it's associated, that operating company would work the same way. Me and some partners own some car washes, works exactly the same way. Services are being offered with the real estate, and it turns that into an ordinary loss. So those are the main ways that we figure out how to take advantage of those losses.
I appreciate that. I know a lot of people listening to this are going to think this sounds like a foreign language to me, and that's okay. I know that I'm a CRNA, and all of our audience, mainly SRNAs, CRNAs, maybe soon to be SRNAs, they're in healthcare, so they're experts in healthcare, they're experts in anesthesia. We have experts and resources just like Levi here to help you with these decisions when it comes to tax planning, real estate, understanding how to go from a $600,000 income as a 1099 locum and pay maybe 10% tax, 5% tax, 0% tax. I
Yeah.
did see a question in here, and I want to go over this real quick. I think a lot of people don't realize there's a lot of ways to be involved in real estate. Doesn't mean you have to go out there and personally be the only one involved in the transaction when it comes to residential or commercial properties. And so somebody asked, it looked like they may have been a student in SRNA. Maybe they're not out in the job force yet. They said, I've been hearing that it takes 24 months or longer to show income before I'll be allowed to have, a mortgage or maybe a loan to get into real estate. And that's just not true because there's other vectors that you guys can use. And there's actually CRNA groups out there and I mean, plenty of businesses that you guys can join with. You can be a part of real estate. And I want you to answer this, Levi. Could they still get those tax advantages depending on how they're set up in partnerships or limited
Yeah.
partnerships with other people's real estate? And if we can hit on this for maybe 2 to 3 minutes, then we'll
Okay.
dive
I'll
into
I'll go
kind of
fast. Yeah.
the
Okay.
retirement side.
Yeah. Yeah, no, that's a great question. And to summarize, by the way, the 24-month thing, Michael's absolutely right. Like let us, again, as CLJ's network of resources or our network of resources, let us find you. And even if we're just talking about buying a personal residence, if that's something you need to do the first year out, that 24-month lie is there's just so many workarounds. I mean, starting from a physician's loan on down. You can always refinance into a traditional product later. Michael's alluding to passive partnerships, or sometimes they're called syndications, where you're not assuming the debt yourself. You're not personally guaranteeing. So, by the way, remember that takes that risk vector out of it. So factor that in. You're usually getting less of a return because someone else has to operate this portfolio for you. And so there's a trade off. We do one that's specifically designed for tax savings every year. It's a package of single family rentals, great return, 30% annualized over 5 years, or each of the 5 years. There's another great CRNA that has a company called Excite Capital. A good friend of mine, Leslie Awasam, and their group does a lot of apartment syndications. So there's all kinds of options in the context of limited partnerships, and even on your own portfolio. Last point here is there's something called DSCR loans, which are not personally guaranteed. It's not going to be underwritten based off of your personal credit. It's going to be based on how this would perform as a rental. The rates are usually a little bit higher, but even for your own portfolio, there's options.
So would a locum be able to still receive some great tax advantages even in these scenarios?
All of the above. Yeah, all of the above, as long as your investment is equity. So you want to make sure, if you're talking to a group, that it's an equity investment. Equity means that the depreciation loss is going to flow back to me.
Right. So I know this whole time, and we want to go over this in more detail, and we will. Levi will, and I will continue to do these lives throughout the year. But we want to still talk about retirement, which a lot of you guys, and I know the audience understands a lot more than real estate. We've spent a lot of time just on residential,
Yeah.
commercial real estate, how that looks, how the tax advantages can help you when it comes to bringing down that 1099 or locum W-2 CRNA income. But let's just hit on retirement real quick. If you were to ask me, I'm a big fan of diversification. So when it comes to do you do retirement or real estate? I think why not both? If I'm a locum
Yes.
CRNA making $450,000, $550,000, there's room for me to put in a bucket of retirement. Maybe I'm married or have a spouse. They can put into the solo 401k as well. Now we still have money left over. We've already brought our taxable income down.
Yep.
Maybe now we dive into some real estate as well. But I'll let you take the floor on that. I know this talk was about retirement
Yeah.
or real estate,
Right.
or we're going to bring them both in now.
Yeah, absolutely. So I love stocks, and there's things that I love about them that real estate does not provide me. And one of the big ones is liquidity. The ability to access that liquidity is not there for a few years in a building that you're invested in, unless you do it with very little leverage, like you put 50% down. It's very hard to get at that liquidity. And so I'll mention two things as pros in this column and why I do both. Liquidity is one, and really comparing apples to apples. Real estate being a passive investment is what I call a bit of a joke. I'm invested in Ford Motor Company. They've never asked me to plunge a toilet, but I have had a renter that has. And there's always an emergency with a real estate portfolio, especially as it grows. There's always a cost, and that cost is not just financial, it's your time. And the most valuable thing to do if you're a locum CRNA is spend your time in a surgery room. That is the best return on your time. And so stocks are truly passive. It's going to grow in your sleep. It's going to continue to compound. It compounds immediately, which is different than how the math works in real estate. And that compound growth is a powerful thing combined with it's truly passive. One more note on liquidity. A lot of people don't know this. This is sold in the insurance products, but in a taxable brokerage account, you can leverage against that taxable brokerage account and have access to that liquidity without selling your stocks. Because from a stock standpoint, I'm a buy and never sell guy.
Right.
So I don't actually want to sell the asset. I just want to access the value.
Would you consider that a securities line of credit, Levi? Is that when
Yep.
you access
Yep.
that?
And it's completely doesn't show up on your personal credit. It is completely secured against that
And
stock.
that's when you're leaving your asset, now the stock actually in place. It's still compounding. You're not
Right.
paying long-term, short-term capital gains. You're leaving it alone, but
Yep.
now you're accessing money. And just if you want to do some quick math,
Okay.
long-term capital gains, let's say 20%.
Sure.
What are you going to pay on a securities line of credit? Even say it's 10%.
Yeah.
20 versus 10, you've actually
Yep.
saved money and you're keeping your asset in place. It's still growing. So
Yeah.
it's almost kind of a no-brainer when it comes to that leverage, not only with real estate, because you can do similar things,
Sure.
but when it comes to assets in stocks or non-retirement brokerage accounts.
This what part of what you're describing on the tax side is the famous strategy known as buy, borrow, die.
Mhm.
You buy the asset and you borrow against it, and then you die, and then your heirs don't even pay taxes at the end because it gets us the step up in basis. And so, yes, this is why Fortune 500 company CEOs do not want to get paid in a $3 million W-2. They want to get paid in stock where they don't have to recognize the taxable event. And once again, that's one of those tax fraud loopholes that's available to everyone.
Yeah.
The billionaire and the 100,000aire. So there's advantages to both.
I love it. We're at 30 minutes. Typically, we're at 30 minutes on live. So, Levi and I will continue doing these throughout the year. You guys send us DMs if you have specific questions you want answered on the next couple that we do, or you have topics that you want covered. We'll be happy to do those. And you guys will see us again. If you need to get in touch with Levi, check out our link tree on our bio. You'll be able to find his website. Let him know that COJ sent you over. He takes care of hundreds of CRNAs as well as me personally and CRNA Locum as a company. Him and his crew have done a great job the last several years that we've been with Levi, and you will see Levi soon again.
Thank you, Michael. Thanks everyone for joining.
Of course. Take care.